Here to weigh in is the former Kansas City Fed president, Thomas Hoenig. Thomas, good to see you. So last time you were on, back in December, I think we talked about this, and you said that if the CPI came in not so hot, you would expect cuts. Well, it came in hotter than the numbers that you gave. So what now? Does the Fed just accept without outright saying that 3% is okay?
That's a very good question. And I think this number came up higher, but I think the more important information on this is that the CPI, total inflation, has been in the 3% or higher level since the middle of 2023. So it hasn't really been coming down as the Fed expected, and their willingness to rely on the long and variable lags of monetary policy to bring it down. So they have a new dilemma. But it appears that they've going to accept 3% as good enough for now, and therefore they're unlikely they're going to raise rates. They've made that very clear, but it does affect the timing of the rates going forward. And I think they're still going to rely on the idea of lag effects. Consumer is slowing, except their earnings are rising, and how will that play out? Investment is slowing, except for technology. We have chips, infrastructure, and green energy. So how will those two play off one another as far as growth going forward? So I think they have some challenges ahead of it. And if I could say one other thing, they have they're shrinking their balance sheet as this takes place, and that means there'll be upward pressure on interest rates if this continues, especially as the government has to issue enormously larger amounts of new debt. That kind of pressure will then, I think, put pressure on the Fed to stop quantitative tightening in the middle of this. So they're in a tough position. Yeah, go ahead, ask me.
So which, from your seat, is riskier right now for the Fed? Cutting too soon and restarting an inflation inferno, or holding too long and triggering a recession?
I think if they cut too soon and reignite inflation, they'll lose a lot of credibility, and they can't afford to do that. So I think that's their bigger risk. And I think they're weighing that against the fact that they do know quantitative tightening and having its effect as well. So they're in a dilemma, but I do think their greater risk is cutting too soon. If they lose that momentum, their credibility will fall, and I think inflation will be much harder to bring down to that 2% later.
Thomas, we seem to have a little bit of a wild card here. And what I mean by that is we've seen the unwinding of these pandemic-era supply chain shortages that did push prices up, particularly on the goods side. Now you have conflict with Houthi attacks on commercial vessels in the Red Sea. You've got reports just today that Tesla may halt most Berlin site output due to that. Maersk warning that it could take months to reopen the Red Sea shipping route. And now reports, even just in the past hour or so, that the U.S. and the U.K. are preparing launch strikes against the Houthis in Yemen. As you see this scenario play out in a key trade route, how real is the risk to some of those areas where we've seen not only disinflation, but even deflation, reigniting and reversing?
Well, I think those events would have, I think, more effect on slowing the reduction in inflation, unless we do break out in a global conflicts all over and stopping trade. Otherwise, they'll have some effects, but I don't think they'll be the major factor causing rapid increases in inflation. They have that to worry about. I mean, it's something they have to worry about. It's not the overwhelming factor at the moment. I think at the moment, they still have very strong labor markets pushing forward. They have a lot of demand in the economy, and they have a lot of debt to refinance. It's going to push interest rates up. Those factors will both push inflation up and pull back, and they're trying to thread that needle. And they are in a difficult spot trying to do just that. But I think overall, they're going to while the bigger risk is easing too soon, they're going to be under enormous pressure and a lot of temptation to go ahead and reduce interest rates at some point in the first half of this year.